The United States government is now paying more to service its debt than it spends on national defense. In the first 6 months of fiscal year 2026, the Treasury paid $529 billion in interest alone, roughly $88 billion per month. That is more than the combined budgets of the Department of Defense's military operations and the Department of Education over the same period. And yet the Federal Reserve, the one institution with the power to lower that cost, has frozen in place. It has held interest rates steady at 3.5% to 3.75% across 3 consecutive meetings, January, March, and the signal is the same for April. Not because the economy is perfect, not because inflation has been tamed, but because every direction the Fed could move leads to a worse outcome than standing still. This is not a policy choice. It is a structural trap, and by the end of this script, you will understand the exact mechanical forces that built it, forces that most financial commentary refuses to name. If you leave now, you will miss the 3 specific publicly trackable signals that reveal how this trap resolves. The confusion is understandable. The headlines seem contradictory. The economy is expanding at a solid pace. The Fed's own statement says so. GDP growth is projected at 2.4% for 2026. Unemployment has stabilized around 4.4%. Consumer spending continues. So why does the bond market behave like something is breaking? The answer is the iceberg rule. The headlines show the surface, a functional economy, a central bank doing its job, markets that bounce between optimism and fear. But the mass below the waterline is what moves everything. And below the waterline, the structural math has shifted. Here is the data point that makes the confusion paradoxical. The Congressional Budget Office projects net interest payments on the national debt will total $1 trillion in fiscal year 2026. That figure is not a projection for some distant decade, it is this year. It is now the second largest line item in the entire federal budget, behind only Social Security. It exceeds Medicare, it exceeds defense, and it is growing at 6.1% year over year through the first half of fiscal 2026. Even as the Fed has already cut rates 3 times in late 2025. The surface says stability. The structure beneath says something else entirely. The immediate trigger is the March 2026 inflation report. The Consumer Price Index surged 0.9% in a single month, the largest monthly increase since June 2022, pushing the annual rate from 2.4% in February to 3.3% in March. Gasoline prices drove the spike, surging 21.2% in 1 month, the largest monthly jump in that series since the Bureau of Labor Statistics began tracking it in 1967. Energy prices overall rose 10.9% in March, driven by the Iran conflict and the effective closure of the Strait of Hormuz, through which roughly 1/5 of the world's oil supply transits. Oil briefly surpassed $110 per barrel. Think of this as a dam, a structure holding back an enormous reservoir. For months, the dam held. Inflation had been easing. The Fed had room to cut. The rate path seemed clear. Then a crack appeared, not from inside the system, but from a geopolitical shockwave that sent energy costs through the roof. And now, every hairline fracture in the structure is visible. The core CPI, which strips out food and energy, rose just 0.2% for the month and 2.6% year over year. The underlying inflation engine has not reignited. But that distinction does not matter to the bond market, and it does not matter to the Fed's credibility. Headline inflation is what consumers feel, and headline inflation just jumped by nearly a full percentage point in 30 days. Economists at EY estimate that the war's second-order effects, higher fertilizer costs feeding into crop prices, rising shipping surcharges from carriers like UPS and FedEx, airline fuel surcharges, could push headline CPI to 3.6% by May. Food inflation, currently at 2.7%, is expected to climb above 4% in the near term as those supply chain costs flow through. Real earnings for American workers fell 0.6% in March alone. Average hourly earnings rose just 0.2%, while the cost of living jumped nearly 5 times that. The purchasing power of the average paycheck is shrinking in real time. The Fed's 2% inflation target is now further away than it was 6 months ago, and the institution designed to close that gap cannot move. What the headlines call a policy pause, the structure reveals as paralysis. The Federal Reserve held rates steady at its March 18th meeting, voting 11-1 to maintain the target range at 3.5% to 3.75%. The lone dissenter, Governor Christopher Waller, wanted a quarter-point cut. The Fed's own dot plot still signals one cut in 2026 and another in 2027. But market pricing tells a different story. Futures markets have priced in at most 2 rate reductions in 2026, and some contracts now reflect meaningful odds of 0 cuts. The gap between what the Fed says and what the market believes has widened into a chasm. This is the chess king with no clean moves. If the Fed cuts rates, it risks reigniting inflation that just printed 3.3%, an act that would shred its remaining credibility after 5 years above target. If the Fed raises rates, it accelerates the interest cost on a $38.98 trillion national debt that is already devouring the federal budget. Every additional basis point on Treasury yields adds billions to the annual cost. The Committee for a Responsible Federal Budget estimates that if long-term rates remain just 30 basis points above CBO projections, interest costs rise by an additional $1 trillion over the next decade. And the institution itself is fracturing. Jerome Powell's term as chair expires in May 2026. Kevin Warsh has been nominated to succeed him, but Senator Thom Tillis is blocking the confirmation until the Justice Department drops its investigation into the Fed's headquarters renovation, an investigation Powell has called a pretext to pressure the central bank on rates. A federal judge agreed, quashing the DOJ subpoenas. Powell has stated publicly that he will remain on the board, potentially as chair pro tempore, until the investigation concludes. Trump has stated publicly that he would fire Powell if he stays. The Supreme Court is simultaneously weighing the legality of firing Fed Governor Lisa Cook. The institution tasked with managing the world's reserve currency is in a leadership crisis during an inflation shock, a war, and a fiscal spiral simultaneously. The mechanism dictates that policy uncertainty compounds financial uncertainty, and compounding is happening now. The structural consequence is arithmetic, and arithmetic does not negotiate. As of April 3, 2026, total gross national debt stands at $38.98 trillion. Over the past year, that figure has increased by $2.77 trillion, an average of $758 billion per day. The debt reached $39 trillion on March 17, 2026, just 145 days after crossing $38 trillion. Think of this as the minimum payment trap on a credit card the government cannot cut up. The balance never goes down. The interest keeps compounding. And the minimum payment, now $1 trillion a year, consumes more of the household budget every month. The average interest rate on total marketable national debt is 3.365% as of March 2026. 5 years ago, it was 1.512%. That difference, applied to $39 trillion, is the structural consequence in a single number. Debt held by the public has reached approximately 100% of GDP. The CBO projects it will climb to 120% by 2036, with cumulative deficits of $23.1 trillion over the next decade. Net interest as a share of total federal outlays is forecast at 13.95% in fiscal 2026, rising to 14.94% by 2028. And here is the number that defines the trap. The CBO's February 2026 baseline projects that the average interest rate paid on the national debt could exceed the economic growth rate starting in fiscal year 2031. When that crossover occurs, the U.S. enters what economists call a debt spiral, where interest costs increase interest rates, depress growth, and depressed growth further increases interest costs. The only question is speed, not direction. In 1971, President Nixon closed the gold window, ending the dollar's convertibility to gold at $35 per ounce. At that moment, total U.S. national debt was $398 billion. The federal government ran a deficit of $23 billion. Interest payments on the debt totaled $21 billion for the year. Today, the national debt is $38.98 trillion, nearly 98 times larger. The annual deficit is projected at $1.9 trillion, 83 times larger. And interest payments alone are projected at $1 trillion for fiscal 2026, 48 times larger than the entire interest bill in 1971. But the comparison that reveals the mechanism is the debt-to-GDP ratio. In 1971, national debt was approximately 35% of GDP. Today, it exceeds 120%. The structure is not just bigger, it is more leveraged relative to the economy that must service it. In 1980, when Paul Volcker raised the federal funds rate to 20% to crush inflation, total national debt was $908 billion. He could afford to raise rates aggressively because the debt burden was manageable, roughly 32% of GDP. The Treasury could absorb the higher interest cost. Today, the Fed cannot replicate the Volcker play. Every 1% increase in average rates on $39 trillion of debt adds roughly $390 billion in annual interest expense. That is more than the entire federal deficit of 1980. When Volcker acted, gold was trading near $800 per ounce. As of April 21, 2026, gold trades near 4,682. The asset that central banks hold as the ultimate reserve has repriced by a factor of 6. The numbers sit without commentary. In Q4 2025, while the financial media debated whether the Fed would cut once or twice in 2026, central banks around the world were buying gold at a pace that told a different story. Net central bank gold purchases totaled 230 tons in Q4 2025 alone, a 6% increase from the previous quarter. For the full year, central banks purchased 863 tons, with Poland leading at 102 tons, followed by Kazakhstan at 57 tons. The World Gold Council's 2026 survey found that a record 43% of central banks plan to increase their gold holdings, the highest level of optimism in the survey's 8-year history. The average retail investor, meanwhile, was focused on whether the S&P 500 would hold above 7,000. They were watching the surface, the headlines, the Fed press conferences, the talking heads explaining that inflation was under control. They arrived at the gold trade after the price had already risen over 40% in 2025, from roughly $2,600 to above $4,000 per ounce. The institutional player, the central bank, the sovereign wealth fund, was positioned 12 to 24 months earlier. Poland announced its target of 20% gold reserves in late 2024 and began buying systematically regardless of price. China continued accumulating, an estimated 225 tons in 2025, even after officially stopping its public reporting of gold purchases in May 2024. The contrast is structural. The retail investor buys the narrative, the institutional player buys the math. One waits for certainty, the other builds a position before the narrative catches up to the mechanism. Central bank gold purchases have exceeded 850 tons annually for 4 consecutive years now, more than double the 2010-2021 average of 473 tons. This is not a trade. This is a repositioning. Before we get to the signals, tell us in the comments, has the rising cost of your government's debt changed how you think about the cash sitting in your savings account? No predictions follow, no financial advice. 3 mechanical indicators, instruments on a dashboard. Each one is public. Each one is trackable. The direction tells you where the mechanism is pointing. Signal 1. The 10-year Treasury yield. Track it on FRED, Federal Reserve Economic Data, Series ID DGS-10, or at the U.S. Treasury's Daily Treasury Rates page. The 10-year yield measures what investors demand to lend to the U.S. government for a decade. It has risen from 4.0% at the end of February 2026 to above 4.4% by late March. When this yield rises while the Fed holds rates steady, it signals that the bond market is pricing in inflation risk, fiscal risk, or both, independently of the central bank. The direction to watch is sustained movement above 4.5%. That level signals the market is demanding a structural risk premium to hold U.S. government debt. Signal 2. The Treasury auction bid-to-cover ratio. Track it at treasurydirect.gov under auction results. The bid-to-cover ratio measures how many dollars of investment chase each dollar of debt offered for sale. In March 2026, the 2-year note auction posted a bid-to-cover of just 2.44, the narrowest since May 2024. Primary dealers absorbed nearly 24% of the issuance, roughly double the normal share. When dealers, the bidders of last resort, take an outsized share, it means other investors are stepping back. The direction to watch is consecutive auctions where primary dealer absorption rises above 20% and bid-to-cover falls below 2.4. That pattern signals eroding demand for U.S. debt at a moment when $10 trillion must be rolled over this year. Signal 3. Net central bank gold purchases, quarterly. Track it through the World Gold Council's quarterly gold demand trends report at gold.org. This metric measures the tonnage of gold being added to sovereign reserves worldwide. Quarterly purchases above 200 tons signal sustained institutional repositioning away from dollar-denominated reserves. In Q4 2025, the figure was 230 tons. The WGC projects 850 tons for full year 2026, still historically exceptional. The direction to watch is whether purchases accelerate even as gold prices remain above $4,500 per ounce. If sovereign buyers continue accumulating at elevated prices, it confirms that the buying is strategic, not speculative. It signals that the institutions managing national reserves have reached a conclusion about the long-term trajectory of the dollar. The mechanism in 4 statements. The U.S. government pays $1 trillion per year to service $39 trillion in debt. The Fed cannot cut rates without reigniting inflation. It cannot raise rates without accelerating the fiscal spiral. And the institutions that hold the world's reserves are quietly repositioning out of the asset that depends on this system holding together. Picture a scale. On one side, $39 trillion in obligations growing at $758 billion per day. On the other, a central bank frozen between 2 fires, its leadership in transition, its independence under direct political assault, and a war driving energy costs through the ceiling. The math does not require a prediction. It does not require an opinion. The debt compounds, the interest accrues, the trap tightens. The mechanism is already in motion.